Navigating the bond market symphony, the impact of interest rate changes on bond prices. In the intricate world of finance, the relationship between interest rates and bond prices is akin to a delicate dance. A finely tuned symphony that resonates through the vast expanse of the fixed income market. Investors seeking to unravel the complexities of this dynamic must comprehend the nuanced interplay between interest rates and bond prices. A relationship that holds profound implications for portfolio management and risk mitigation. Understanding bond prices and interest rates. At its core, the price of a bond and interest rates share an inverse relationship. When interest rates rise, the prices of existing bonds tend to decline, creating a seesaw effect that reflects the fundamental principles of fixed income securities. To decipher this relationship, consider a hypothetical bond with a face value of $1,000 and a fixed annual interest payment of $50. If interest rates in the market surge, new bonds issued with higher yields become more appealing, causing the price of existing bonds with lower yields to fall. Conversely, in a declining interest rate environment, existing bonds with higher coupon rates become more attractive, leading to an increase in their prices. This inverse correlation is a crucial factor for bond investors to consider, as fluctuations in interest rates can significantly impact the valuation of their fixed income holdings. Duration, the pivotal metric. In the realm of bond analysis, duration emerges as a pivotal metric that encapsulates the sensitivity of bond prices to changes in interest rates. Duration measures the weighted average time it takes for an investor to recoup the bond's price through its present value of future cash flows, including periodic interest payments and the return of principal at maturity. A bond with a longer duration is more susceptible to interest rate changes, experiencing more significant price fluctuations in response to shifts in market yields. Investors often use duration as a risk management tool, gauging the potential impact of interest rate movements on their bond portfolios and adjusting their asset allocations accordingly. Interest rate risk, the specter looming over bond investments. Interest rate risk looms as a specter over bond investments, and its impact is particularly pronounced in a rising rate environment. Investors holding fixed-rate bonds may witness the market value of their holdings decline as new bonds with higher coupon rates attract buyers. This scenario can lead to capital losses for bondholders who choose to sell their holdings before maturity. Consider a scenario where an investor holds a bond with a face value of $1,000, a coupon rate of 3%, and a remaining maturity of 10 years. If prevailing interest rates increase to 4%, a new bond with a comparable risk profile would offer a higher yield, making the existing 3% bond less attractive in the secondary market. As a result, the price of the existing bond may decline, introducing interest rate risk into the investment equation. Conversely, falling interest rates can enhance the market value of existing bonds. Investors holding fixed-rate bonds may experience capital gains as the prices of their bonds rise in response to the increased demand for higher-yielding securities. This phenomenon can be particularly advantageous for bondholders who choose to sell their bonds in a declining rate environment. Realizing capital appreciation in addition to the periodic interest income. Callable bonds and the twist in the tail. The impact of interest rate changes on bond prices takes an intriguing twist when considering callable bonds. Callable bonds grant issuers the right to redeem the bonds before maturity, usually when prevailing interest rates are lower than the bond's coupon rate. In a declining interest rate environment, issuers may choose to call existing bonds and reissue new bonds at lower coupon rates, creating a potential headache for investors. Imagine an investor holding a callable bond with a coupon rate of 5% and a remaining maturity of 10 years. If interest rates fall to 3%, the issuer may exercise the call option, redeeming the existing bond and issuing new bonds with a lower coupon rate. While the investor receives the face value of the bond, they must reinvest the proceeds in a lower-yielding environment, potentially diminishing their overall returns. The yield curve's role in the ballet. To unravel the intricate dance of interest rates and bond prices, investors must also pay heed to the yield curve, a graphical representation of the relationship between bond yields and maturities. The yield curve's shape, whether steep, flat, or inverted, offers insights into market expectations and economic conditions. In a steep yield curve environment, where long-term interest rates exceed short-term rates, investors may witness increased interest rate risk for longer duration bonds. A flat or inverted yield curve, on the other hand, can signal economic uncertainties or an impending recession, influencing investor preferences for shorter duration securities to mitigate interest rate risk. Central bank policies and the echo in bond markets. Central banks, as architects of monetary policy, exert a profound influence on interest rates, sending ripples through bond markets. Changes in policy rates, as communicated through central bank statements and actions, can trigger significant movements in bond prices. Investors keenly scrutinize central bank decisions, anticipating shifts in interest rate trajectories and adjusting their bond portfolios accordingly. Consider a scenario where a central bank signals an intention to raise interest rates to curb inflation. Bond investors may react by adjusting their portfolios to account for the potential impact of rising rates on bond prices. Conversely, a central bank's decision to lower rates in response to economic challenges can spark demand for bonds, driving up prices as investors seek higher yields in a lower interest rate environment. Conclusion: in the grand symphony of the bond market, the impact of interest rate changes on bond prices resonates as a fundamental melody, guiding the movements of investors and shaping the dynamics of fixed-income portfolios. The inverse correlation between bond prices and interest rates, coupled with the nuanced interplay of duration, callable bonds, and the yield curve, demands a symphonic understanding from investors navigating this complex terrain. As interest rates ebb and flow, ushered by economic currents and central bank orchestrations, astute investors attuned to the melodies of the bond market can navigate the undulating landscape with finesse. It is a landscape where interest rate risk is both a potential pitfall and an opportunity, where the interplay of market dynamics and investor acumen harmonize to create a symphony of returns and risks. In this intricate ballet, investors armed with knowledge and strategic insight can waltz through the ever-changing movements of the bond market, ensuring that their portfolios resonate with resilience and adaptability,